Hi, this is Dee from Digrashka.com. This video will be all about delta in options pricing. We'll be discussing the relationship of the options prices to the price of its base instrument. How do option prices react to changes in base price? For discussion purposes, we'll use stocks as the underlying or as our base instrument. From previous discussion, we already know that should the stock or the base price increase, the call option value increases and the put option value decreases. The opposite happens when the base price or the stock price decreases. The call option loses value and therefore decreases, and the put option increases in value. Options, however, do not participate in a 1:1 ratio with the base or the stock price. Every option has a metric called delta, and delta expresses the value of change for every $1 movement in price. The more in the money an option is, the more delta factor it has. This just means that the deeper in the money an option is, the more it participates or is affected by the next dollar change in the stock price. Options that are perfectly in the money have a 0.5 delta, meaning that for every $1 change in the base price or the stock, they participate on a 50-cent basis, or 50%. Delta is an option Greek. Some use it interchangeably as probability in the money of an option. I'd like you to look at a screenshot I took for you of Nike. On the left side are call options, and on the right side are put options. Irregardless of calls or puts, you will notice that the delta factor increases the more the option goes in the money. The price development of a call option as to underlying price is not linear. The nearer an out-of-the-money option strike is to the underlying, the more worth the option will carry due to the chance of the option actually ending up in the money. The more in the money the option gets, the more delta factor it has, and deep in the money options have a delta value near 1. And this is a point where the call option is so deep in the money that it reacts almost 1:1 for every $1 move. Don't forget, at the money calls have a delta value of 0.5. The price development of a put as to the underlying price is not linear. The nearer an out-of-the-money strike is to the underlying, the more worth it will carry due to the chance of the option actually ending in the money. So option values increase exponentially as they go to the journey of being out of the money, into being in the money, into being very deep in the money. And deep in the money options have a delta near 1. And this is just the point where the put option is so deep in the money it reacts almost on a 1:1 basis for every $1 move. Don't forget, ATM puts have a delta value of -0.5.